Now, going forward with our discussion, in money market there are no major amendments as such because SEBI is not involved as far as money market is concerned. See, most of the amendments are made by SEBI. In case of money market, which is chapter number 7, the amendments will be far and few between because it's mainly governed by the RBI. So those amendments will not basically apply to you, and what the content of the chapter is, it's mainly treasury bills and all that. So there are no major amendments as far as that are concerned. Whatever is there, I have incorporated it. Okay. If you see the introduction, see, money market is basically a market which deals in lending and borrowing of short-term finance varying from 1 year or less. So the first thing that you need to understand, it is the short-term market. It is a market which is there for less than 1 year. Monetary assets of closed-term nature up to 1 year, financial assets that are close substitutes for money. Money market have a characteristic of liquidity. Then money market is a primary mechanism through which central bank influences liquidity and general level of interest rates. It acts as a wholesale debt market for low risk, high liquid short-term instruments. So the thing that you need to know about money market is, the first thing is that it is a low risk market. Any person who does not want to invest in high risk securities will play in the money market. Secondly, there are very liquid securities, so you can easily encash them for your money, and they are short term, so they are less than 1 year. Anything more than 1 year is not a money market instrument. So you can put it as a note. Anything which is more than 1 year, it's not a money market instrument. And this is the way in which central bank also regulates the total money that is flowing in the economy. It regulates the interest rates. You must have heard, from time to time, central bank is going to drop the interest rate or increase the interest rate. So this is the money market is the way in which they influence liquidity, credit flow. They specify different types of CRR, different types of SLRs for the banks. Then they specify interest rate. What is interest rate is basically they specify a base rate. So below that rate, no lending can happen. So if that rate is increased, then automatically the amount of credit that is there in the market decreases. If that rate is decreased, automatically the amount of money flowing in the market increases. So that's why you see, whenever there is a drop in interest rates, the stock market really goes up by number of points. So that is how they control it. Okay. So that is there in the third and fourth paragraph. Basically, what I have told you, banks are not allowed to lend out the entire amount. There is something called as the SLR, something called as the CRR. The features of money market is basically it's a wholesale market where the volume of transaction is large, settled on a daily basis. Trading is conducted over phone, followed by written confirmation. So what are the difference between the money market and capital market? Okay, so first difference is maturity. Lending and borrowing of short-term finance varying from 1 year or less. So money market is 1 year or less. This is more than 1 year. Second is the instruments that are there in the money market are call money, treasury bills, commercial papers, bills of exchange. I have not included certificate of deposit, but that is also an instrument. And capital market, you all know, it is shares, stocks, debentures, bonds, corporate deposits, which is inter-corporate deposits, etc. What are the institutions involved? Mainly it is central bank, commercial banks, non-banking financial institutions, and here it is stock exchange, SEBI, corporates. Purposes, short-term credit. Here the purpose is long-term credits. Risk and liquidity, the liquidity is very high, the risk is very low, but the returns are also very low. Here it is high risk, high reward, and I wouldn't say no liquidity, but it is definitely lower than the money market. Okay. Now, Indian money market consists of two segments, the organized segment and the unorganized segment. Now, we will concentrate mostly on the organized segment in this chapter and for your syllabus, because the unorganized segment, there is no regulations. Unorganized segments are basically what you and I normally know as saukars, or small chit funds or indigenous bankers, money lenders, which are not registered with any statutory authority. There is no regulation regulating them. Of course, they have. It's a large part of the money market. It's not that unorganized market is not existing at all. It's a huge market. But for our syllabus, we are dealing with the organized market. And organized market obviously includes mainly RBI, the public sector banks, that is the nationalized banks, private banks, NBFCs, then insurance companies like LIC, GIC, so on and so forth. Now next thing is, what are the different instruments in the money market? Now first is treasury bills. See, what happens is, the government of any country always spends more than it earns. This is a rule which is there everywhere in the world. It's not there in India, it is there everywhere in the world. See, how does the government earn money? Taxes. Main source, probably the only source, is taxes. Now what they do is, whatever taxes are collected, it is spent for the public welfare. But what happens invariably is, if you are collecting 100 rupees as taxes, if the government collects 100 rupees, it almost all the time spends more than 100 rupees. So how do they finance the deficit? That is why, if you hear the finance minister talk, if you hear in the newspapers, current account deficit is fiscal deficit is so and so. You heard the word fiscal deficit a lot. I think most of you must have heard the word fiscal deficit. Fiscal deficit is very high, it needs to be lowered. What is fiscal deficit? It's basically the excess of expenditure over income at a government level. Okay, so how do they finance a fiscal deficit? Just like you and I finance it. If you are short of money, what you do? You borrow, right? So how does government borrow? The main instrument which government uses is the treasury bills. Okay, it is used by RBI to finance the short-term requirements of the government of India. These are discounted securities and thus are issued at discount to face value. The return to investor is the difference between maturity value and issue price. Now what it means is, if it's an instrument of 100 rupees, if the treasury bill is say 100 rupee treasury bill, it is issued to you at 95 at a discount. There is no interest actually that is paid on a treasury bill. The interest is factored in the price itself. So for 100 rupee treasury bill, you will pay 95 rupees while taking it, and while redeeming it, that is at the maturity date, you will get 100 rupees. Okay, so the discount that is there, that is the income that you earn in a treasury bill. And discount is decided by the government, it is decided by auction basically. Treasury bills are auctioned. In the short term category of investment instrument, treasury bills carries the lowest risk. RBI issues it at a prefixed amount. So like these are the lowest risk bills. Why it is lowest risk is because it is issued by the Reserve Bank of India and it is backed by the government of India. So unless a government itself defaults on the payment, there is a very low risk of getting defaulted. But that is not to say that there is no risk. If you have heard the word sovereign default, you must have heard Greece. There was newspaper reports about Greece economy being in tatters and lot of problems the Greece was facing. Yes, so that was nothing but a sovereign default. What is sovereign default? Basically, when the government defaults, like corporate takes a loan and it defaults, what does the bank do? It goes after the corporate, it takes over their assets and all that. But what happens if a government defaults? If a government issues a treasury bill, then it cannot pay it. That is called as a sovereign default. Then you have to bail out the government in that case. Okay. So there are two types of treasury bills mainly. It's 91-day treasury bill and 364-day treasury bills. So one is which is matures at 91 days. That is approximately, if you say, in 3 months. There is one for 181 days, which is not so common, which is 6 months, and one is 364 days. So if you see, all are less than 1 year. The highest one is also 364 days. It is not 365 because more than 1 year it is not a money market instrument. Okay. So at times when the liquidity in the economy is tight, people prefer to park their money in the treasury bills because they are safe. At least to my recollection, so far government of India has not defaulted. There is no sovereign default that has happened in India so far. Since the time of independence, our government has not defaulted any time. Okay, the debt may be very high, the deficit may have been very high, but we have not defaulted. The same is the case with the American government. That is why if you can write American treasury bills, Federal Reserve treasury bills are considered as the safest investment in the world, because the day America defaults, the world economy is finished. Okay, so now there are, as I said, three types of bills. Maturity is 91 days. This you will need to remember because they might ask you what are the different types of treasury bill. The question that may be asked is, what is a treasury bill? So you will write this first paragraph. Second paragraph you can write, and what are the different types of treasury bills? There are three different types of treasury bills currently. Earlier they were also 14-day bills and all that, but they have all been discontinued now. So now it's only three: 91, 182, and 364. Okay. So 91 days, as I said, maturity is 91 days. It's auctioned on every Friday of every week. Auction amount is 100 crores. So in any given auction, minimum 100 crores is auctioned. 182 days, it's 100 crores. and there is 364 days. Our auction is on alternate Wednesday. Notified amount is 500 crores. The investors in this are the banks, financial institutions. What happens is banks also subscribe to this to meet their short-term requirements. If the bank wants short-term funds, short-term cash, then banks also purchases treasury bills. Okay, or say bank has a statutory liquidity ratio or a cash reserve ratio that it has to keep. We all discuss cash reserve ratio, right? So if it is falling short of the cash reserve ratio, then it will take treasury bills for meeting that shortfall. What are the benefits? The first benefit is there is no TDS, so you save a lot on tax. Second, as I discussed, is zero default risk, that is being sovereign paper, high liquidity, better returns, transparency, simplified settlement. Simplified settlement because everything is done electronically, so it is very easy, and there is no complications. You are getting it at 95 on the maturity. You know that you are going to get 100. There is no complication in that. The yield can also be calculated by a very simple formula. Okay, so the question might be of 2 marks or 3 marks or 5 marks or 7 marks. Okay, depending on the weightage of the marks, you have to write the answer. Concept you have to explain, types of bills you have to explain, and if they ask you the benefits, you have to write these benefits. Even if you just write the benefit, it's okay. You don't need to explain each of the benefits. No tax deducted or so. What does it mean? You don't need to explain. It is obvious what is meant by no tax deducted or so. That you don't need to explain. There are certain features for treasury bills. As I said, bids for treasury bills are made for a minimum amount of 25,000 only and in multiples thereof. So if I want to bid and purchase a treasury bill, minimum amount is 25,000 and multiples thereof. So either I can purchase for 25, 50, 75, 1 lakh, so on. Now who can purchase treasury bills? All entities registered in India, banks, financial institutions, FIIs, state governments, provident funds, even individuals are eligible to bid purchase treasury, but individuals normally don't do it because one is the amount is high and like returns are very low. Now this is a formula for calculating the yield. Yield is basically the returns that you get. So yield of a treasury bill, and this is a fixed formula. This you have to remember. This there is no way to explain it because this is a mathematical formula. So y, where y is the discounted yield, is equal to 100 less p into 365 into 100, p into d. Okay, p is the price and d is the days to maturity. So I'll just give an example. So in your exams, you in the practical questions, they might ask you a question to calculate the yield. Okay, calculate the yield of a particular instrument. If you look at your scanners, they have asked questions in the practical section where you have been asked to calculate the yield. So you see, this is the formula. YTM is yield to market. So this less this into 65 less this is 5.70. 5.70 is basically the return. Okay. So if you invest in this treasury bill, you get a 5% return over say 91 days or 181 days or whatever. Now, how are the treasury bills issued? They are issued by auction. Okay. You must have heard auction, right? Auction is basically nilami, as you say in Hindi, right? So how are they auctioned? The auction of treasury bills is done by RBI. You have to submit your bids on the negotiated dealing system, that is an online electronic system which is managed by RBI by 2:30 p.m. on Wednesday. If Wednesday happens to be a holiday, bids are submitted on previous day. Bids are submitted in terms of price per 100. Okay, so for example, a bid of for a 91-day treasury bill auction could be 97.5 per unit of treasury bill of face value 100. So if it's 100 in terms of 100, so if it's a 1,000 rupee bill, it would be 970. So these are the features. Auction committee decides the cutoff price. So you just read this ABCD, that will give you a fair idea of how main things of the auction, how the auction is done. In India, what is followed is the price based auction. There are two types of auction method. Okay, one is the yield based and one is the price based. Yield based is only for new government securities. When a government wants to issue a fresh treasury bill, it will follow the yield base. But yield base is not there in your syllabus. I have checked that, so I have not included that. Now for reissue of treasury bills, there is a treasury bill which is maturing and the government wants to reissue it. What is used is a price based auction. Now if you read this paragraph and you read this carefully, because this question has been asked a number of times in exams, Price-based auction is conducted when Government of India reissues securities earlier. Bidders quote in terms of price per 100. For example, 100, 2 and all that. Bids are arranged in descending order. So first logic is you first bid. Okay. Where till the time the bidding is on, you have to bid in terms of 100. After the bidding is over, the committee of the Reserve Bank auction committee that will fix a cutoff price. So first logic is anybody who has bid above the cutoff price, okay, or at the cutoff price, they will get the bills. Those who have bid below obviously will not get it. They will get their money back. Okay, this is the example. So this price-based auction exists in Security 8.24 GS 2018. Maturity date is April 22. Coupon is 8.24. Auction date is September 8. Notified amount is 1000 crores. Okay. Settlement is done on September 8, 2008. See, this is how the bids are there. This is the price of the bid. Okay. So he has bid for 300 crores at 100.31, 200, 100.26. So it is arranged in descending order. Okay. And the bid amount is also in descending order. And then there is a cumulative amount. So as soon as they reach 1000 crore, they will stop. So what it's mentioned is issuer will get the notified amount by accepting bids up to 5. So even if I accept the first 5 bids or even the 6th bid, because 6th bid the amount is same, the bid amount is 100.20. So either 5 or 6, either first 5 or first 6 bids if he accepts, then he will get the 1000 crores that which is aiming for. Okay, bids 7 and 8 are rejected, the price is less than the cutoff price. Okay, now here is the main thing. There are two methods of auctioning. Depending on the method of allocation to successful bidders, auction will be classified as uniform or multiple based. The Dutch is called uniform, French is multiple. So in India, French is not very popular, it's not used anymore. We use Dutch method. See, in the uniform price auction, what happens is all successful bidders are required to pay for the allotted quantity of securities at the same rate. Okay. On the other hand, in the multiple auction, the successful bidders are required to pay for the allotted quantity of securities at the respective price yield. Okay, so if you consider this example, if it was a uniform based price, all bidders would get the allotment at a cutoff price that is 100.20. Here he is getting 1000 crores, so this is the cutoff price. Okay, so what it means is even if he has bid 100.31, he will have to pay 100.20. On the other hand, if it's a multiple based price, each bidder would get the allotment at the price he or she has bidded. So that bidder at 131 will get this securities at 100.31 only. He will not get it at 100.20. The number of securities will be less that he will get. Okay. So what is written in your module is, if I'll just open the module. So in India, what we follow is the multiple price based system. We don't follow the uniform price based system. Uniform was followed till for the 91-day bills, but now even that has been discontinued. So what we follow is the multiple, because multiple is followed for the 3 treasury bills. The certificate of deposit is nothing but what we call as a fixed deposit. Okay. So certificate of deposit is a money market instrument which is offered by few banks and financial institutions which provide investors to enjoy the highest rates in comparison to other saving accounts. It is a negotiated money market instrument. It can be less than 5 months. It cannot exceed more than 5 years. So maximum is 5 years. And you deposit your money with the bank essentially. The bank gives you a certificate of deposit, which we also know as fixed deposit receipt or fixed deposit certificate. And that is a money market instrument. It is tradable. You can endorse it. You can give it to somebody else. You can endorse it in somebody else's favor. You can take a loan against that instrument. So it's a very liquid instrument. The guidelines are, it is basically insured by the bank, and in India it is also insured by the Federal Deposit Insurance Corporation, which makes it a pretty safe investment. Who can issue certificate of deposit? Scheduled banks, excluding regional rural banks and local area banks. All India financial institutions that have been permitted by RBI can issue certificate of deposit. So scheduled banks covers basically most of the banks in India, excluding RRBs and LABs. Varying the amount of CDs allowed to be issued by banks, varying according to the requirements, keeping in limit the CRR, SLR. As far as financial institutions are concerned, it may issue CDs within the overall limit that is fixed by the RBI as per the prevailing guidelines. And So financial institutions can issue certificate of deposit together with other instruments, that is term money, term deposits, commercial papers, intercorporate deposit, not exceeding 100% of its net owned funds. So if you are a financial institution, net owned funds is your net worth. It's basically assets less liabilities. Net owned funds is net worth basically. So it cannot exceed 100% of its net worth. Now what is the minimum size? Minimum size should be 1 lakh. It should not be less than 1 lakh and in multiples of 1 lakh thereafter. So minimum certificate of deposit is 1 lakh. NRIs can also subscribe to CDs but only on non-repatriable basis. The maturity period should not be less than 7 days and not more than 1 year. So all FDs are renewed every year. If you see an FD, it's always renewed at the end of 1 year. Minimum 7 days, not maximum is 1 year. FIs can issue CD for a period of not less than 1 year and not exceeding 3 years. So that is the certificate of deposit part. So next is commercial paper. Now commercial paper is again an unsecured money market instrument issued in the form of a promissory note. Promissory note means I issue a note promising to pay the money on a certain date to a certain person or to whoever he endorses it. That is called as a promissory note. I promise to pay. That is called as a promissory note. Now, commercial paper is a privately placed instrument introduced in 1990 with the view to enable highly rated corporate borrowers to diversify their sources of short-term borrowings. So, as opposed to CDs, CDs is basically certificate of deposit, which are issued by banks and financial institutions. Commercial paper is a way by which companies borrow. It was introduced as a way for companies to borrow money at a short-term basis at a lower rate of interest. But not all companies can issue commercial papers. It is a privately placed instrument. First is eligibility. Companies, PDs, and financial institutions are permitted to raise short-term resources under the umbrella limit fixed by the RBI are eligible to issue commercial papers. Now, when will a company be eligible? The tangible net worth of the company is not less than 4 crores. This you'll have to remember. If there may be a question asked as what is the eligibility criteria for issue of a commercial paper by a company. Questions are going to be concentrated on the company's side. Okay. Or it can be turn around the question in another way that a company's net worth is so and so. Can it raise a commercial paper? Okay. So what is the net worth should be minimum 4 crores. Should not be less than 4 crores. The company should have been sanctioned working capital limits by banks and FIs. So they should have already having some working capital limits which are sanctioned by the banks or financial institutions. The account of the company is classified as a standard assets by the financing bank and institution. What is mean by standard asset is the company has not defaulted on the payment. Okay. Standard means when a company takes a loan and it is servicing the loan regularly. These are all financial terms which you will need to understand. Servicing of a debt means you are paying interest regularly and on the maturity you are repaying the money. So you are servicing the debt properly. So as long as you are servicing your debt properly, it is called as a standard asset. The day you default, you become a NPA. If you must have read in newspapers NPA situation of the banks, India's NPA situation. So NPA is non-performing asset. The full form of NPA is non-performing asset. Okay. So when you don't service your debt properly, you become a non-performing asset. So if you are an NPA company, you cannot raise a commercial paper because you are not a standard accountant. You are classified as an NPA by the banks. There is one more thing, which is the rating requirement. You must have we have seen in credit rating, right? Chapter how is the rating calculated and all that. So minimum A3 rating should be done by the company. If the company should have a minimum of A3 rating, it can be above that, but it should not be below that. So the net worth should be 4 crores. It should be a standard account. It should have already had limits sanctioned by the banks. Credit rating of at least A3. If all these conditions are met, then the company can issue commercial paper. Again, it can maturity is 7 days, maximum of 1 year. Again, as I said, it's a money market instrument, so it cannot be more than 1 year. Denomination is 5 lakhs, multiples thereof. Now, the aggregate amount of CP from an issuer shall be within the limits as approved by the board or the quantum directed by CRA. And there is an overall umbrella limit specified by the RBI, which you cannot exceed. So, there are two limits. Okay. there is an overall limit which is specified by RBI, which you cannot exceed under any circumstances. And at a company level, whatever limit has been approved by your board of directors or the credit rating agency, whichever is lower, you have to stick to that limit. So within that limit, you can issue commercial papers. So then you have somebody called as a issuing and paying agent. It is nothing but a bank. So how it works is your commercial papers are not issued directly. Your commercial papers are issued through a bank. The bank acts as the issuing and paying agent. So if I want to invest in a commercial paper, I give the money to the bank and the bank forwards it to the company, and the return is the same. On the date of maturity, the company repays the bank and the bank repays the investor or whoever is invested, and the bank will charge a commission for that. Now every issuer must appoint a IPA. Issuer should disclose the potential investor financial position and all that. After the exchange of deal confirmation between the investor and issuing company, shall issue physical certificates to investor or arrange for crediting the CP to the investor's account with a depository. Investor shall be given a copy of the IPA certificate to the effect that issuer has a valid agreement with the IPA. So what is the roles and responsibilities? Issuer basically has to maintain the eligibility criteria at all times. That is the only responsibility of the issuer. As far as IPA is concerned, it has to ensure that the issuer has minimum credit rating. The limits specified by the RBI or the issuer are not breached. All the documents submitted by the issuer are there with the IPA, and you should have a valid agreement with the issuer. So these are the responsibilities of the IPA. Now commercial paper is basically a privately placed instrument. So it's different from CDs. Okay, CDs is issued by the banks, financial institution. This is issued by the companies. So that is a major difference. And apart from that, since it is issued by a private body corporate, there are a lot more restrictions as compared to the banks. Now next is factoring. See, factoring means what? Is basically converting your credit into cash, if I have to put it very simply. So if you are selling, whenever a company sells its goods or services, it always gives credit. It never happens in the commercial world that you sell an item and you get your money immediately. So what is factoring? Basically, when I sell a goods or services and I give credit to that person, or you pay me after 2 months or 3 months or 4 months, whatever is the credit period, but I don't have to want to wait till the 3 months are getting over. So then what I do is I approach a person who is specialized in this. It's called as a factoring agent or a factoring broker, and I tell him that essentially what I do is I get the money from him immediately, as it says 80%, rarely up to 90%. So if I have a receivable in my books, that is some person is going to pay me say X amount of rupees after say 3 months, I enter into an agreement with a person who is a factoring agent or a factoring broker. He pays me 80% of that amount immediately. Okay, the balance 20%, the factoring company pays the remaining amount to the client when the customer actually pays the debt. So it's 80-20, and this is 80-20 is like a thumb rule. It's not any fixed rules or anything. It can be 80-20, it can be 70-30. It depends on how you are negotiated the deal. So what are the steps? The seller interacts with the broker, explains the funding needs. The broker prepares a client profile. Now both agree that factoring is possible. Okay, the broker then puts the seller in direct contact with the funder for any questions. Now the seller may be asked to remit a fee with the formal application. Due diligence will be conducted. Due diligence is basically nothing but an audit which is done of the company or the person who wants to convert his receivables. The person who is funding him will conduct a due diligence, which is nothing but an audit to find out whether he is credit worthy, whether background checks are done and everything is done. Then finally a sanction letter is given to the seller. Within 7 to 10 days of the initial contract with the factors, the agreements are signed, customers are notified. You have to notify the customers, because then what essentially happens is the customers have to pay the third party.